Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I've got a really exciting video for you today. I'm going to show you two stocks that can generate between 500 and 1,000% rates of return, more than double your money over the next 3 years, and pay you 8% while you're waiting. Let's get right into it. The first stock I'm going to take a look at is Verizon. Now, I want to make a point about Verizon. Verizon is an income stock traditionally. You can see it has very low growth, only about 2% a year. The dividend yield is 8%, but it only trades at a PE ratio of 6.57. More on that in a moment. But as you can see, earnings have been there every year. The company's been profitable. Some years they grow, but most of the time their growth has been very flat, so they've only averaged 2% growth. Okay, but their dividend has steadily increased from $1.38 up to over $2.57 last year and expected to continue to grow, albeit at rather slow rates going forward. But now let's bring the weekly closing stock prices into the equation here. And what I want you to see is that the stock price has followed this earnings line, or the orange line on the graph. But it's also over the last 20 years here or so that I'm showing you. I'm going to shorten this to 20 years. Over this 20-year period, the normal price earnings ratio has been about 13.89. That's the blue line. So we got a 13.89 PE and a 15 PE. Up until 2017, the stock historically traded at this 13 or 14 and 15 PE or higher, many times higher. Okay, and even during a period when earnings were dropping, the stock recovered to over a 15 PE. Now, it's trading much below that now, and it has for the last several years. But this low valuation is where the opportunity comes, because I want you to note that the stock is still earning good money. But let me also do something also important. From a cash flow point of view, it's generating very strong cash flows that are well covering their dividend. I'm going to take price and the normal PE off. They've got cash flows that are covering the dividend. And then even their free cash flow is covering their dividend, although it didn't cover it in 2016 and 17, but is expected to grow very strongly going forward. So when I look at this company going in the future, the normal PE has been 13.89, as I showed you. There's no reason to believe that this stock won't return to that valuation. And if it does, your rate of return out to 2025 would annualize at 38.76%, turning $10,000 into $20,000 and pay you $2,000, almost $2,100 while you were waiting, for a total of $22,355 or a 38.76% annualized rate of return. That's the opportunity of the valuation. Now, the second stock I want to show you is AT&T. Now, AT&T shows a very strong dividend growth line here, but then they show a dividend cut. That's not really a cut. And their earnings have been very consistent. They've grown a little faster at about 3.36%. But again, they've been consistently profitable, but they spun off their Time Warner business. And so this dividend cut was a cut because they spun off a big portion of their business that generated income, but they're currently offering a $1.11 dividend, yielding 8.25%, and they can be bought for a PE of 542. Now, traditionally, with very similar growth, as I'll show you here in a moment, this company is traded at 12.32 times earnings. So here we have the normal PE ratio at 12.32. I see no reason why this stock can't get back there again, which would represent a 45.17% annualized return, turning $10,000 into $22,900, plus dividends of about $2,000 for a total of $24,000, almost $25,000 on a $10,000 investment today. And yet everybody's running from this stock. And yet when I look at it historically, this company has always traded above the blue line and in line with the orange line, or in between those two, except for the last several years. And there's no reason for me to see, as long as these fundamentals hold up. And again, the company generates very high operating cash flow to cover their dividend. And the free cash flow picture on AT&T is actually better than what we saw on Verizon. Even though it dropped a little, it's expected to grow dramatically. Now, if you go into Seeking Alpha, you can see that Verizon is up 5.1% today. AT&T, in contrast, is up 8.36% as I'm doing this video. Now, if I go into external research, I'm going to go into Morningstar here. I'm going to start with Verizon. And what Morningstar is saying, that they give Verizon a 5-star rating. Okay, they give it a fair value of $57 a share. Okay, Verizon is currently trading at $32 a share. If I go into AT&T and then also go to Morningstar and get the Morningstar view of AT&T, and I can go to other research, they also give AT&T a 5-star rating. They give it a fair value of 25, and the stock is trading, at just a little around $13 a share. And again, I want to remind you that it's up to $14.57, up 8.33%. But the point is, they talk about both AT&T and Verizon is they don't expect any major liability tied to lead. And the stocks both dropped precipitously yesterday because of this Wall Street Journal articles talking about lead. My point is both of these stocks, as I've pointed out, are low growth income vehicles. The only reason I'm promoting them as a capital appreciation vehicle right now is because they have gotten excessively cheap. But AT&T, has grown at about 3% a year on average, and they're expected to, continue to grow at about 3% per year going forward. These are the times that you want to buy these stocks when they've got good yields, very low valuations, and they're still very profitable companies. I just can't understand how people always want to run from stocks when they're cheap. Anyway, this has been Chuck Carnevale. What I want to point out again here is these stocks have not been good performers, but they've never been bought to be good performers. They've been bought to be good income producers. And both stocks have produced extraordinary income over the last decade and even over the last few years, even though their stock prices have been dropping. And they should have only been bought as income vehicles, just like you'd buy a bond or a CD or something like that. But the beauty is, now that they've gotten this cheap, everybody's down on them, everybody's afraid of them, and everybody's scared of them today, and yet their fundamentals remain intact. They're not going to grow just like they always haven't grown. They're going to produce good cash flows just like they've always produced good cash flows. And eventually, the market's going to price these stocks at the fair values that Morningstar talked about and probably beyond. So if you're looking for good investments with good income and you need income, I believe AT&T and Verizon foot the bill, and I wouldn't be afraid of them now when they're cheap. What other products do you buy that you get mad when they go on sale other than common stocks? Anyway, this has been Chuck Carnevale. Hope you enjoyed this video. This was a highly requested video, so I thought I'd just do a quick video here showing you why I still think Verizon and AT&T are good long-term income investments that can also give you a capital appreciation kicker now if you buy them at these low valuations. Thanks for watching.